Hello listener, this is the Student Score Booster tutorial, the online tutorial class that take care of your JAMB, WAEC, NECO, NAPTEP examination syllabus. Today, we shall be looking at one of the important subjects that cut across all these exams, that is accounting. And in particular, we shall be looking at the introductory aspect of this subject today, financial accounting or the principle of accounting for UTME students. My name is Mutalib Anifowoshe, and after today's presentation, we shall be able to understand the introductory aspect of this subject. We should be able to know the history, nature, and function of accounting, and be able to understand the objective of bookkeeping and accounting, and in particular to be able to understand the difference between these two terms. Also to be able to explain the users and the uses of accounting information and the stages involved in accounting process. We shall be able to also able to analyze the accounting information and the pictures of accounting information, the principal concept convention that guides the preparation of financial statements shall also be discussed. And finally, after this presentation, we should be able to explain the principle of double entry system. To begin with, we will try to look at the meaning of the key terms in this particular presentation. That is what we call bookkeeping and accounting. This is usually come out both in WAEC and the UTME exam, as we are going to be seeing in subsequently. Basically, the term bookkeeping can be defined as the art of recording in the book of account the monetary aspect of commercial and financial transaction. Or it can also be looked at as art of recording the business dealing in the set of books. And also, bookkeeping can also be defined as art of recording business transactions in a systematic manner. If you look at these three definitions from these different authors, we might understand that the bookkeeping is an art. At the same time, basically, it's dealing with recording. You can see the recording across the three definitions. So the key term here is that when you talk about bookkeeping, it's all about recording transactions in the books. However, if you look at the meaning of accounting, the accounting is also the art of recording, classifying, summarizing in a significant manner, and in terms of money, transaction and event which are in part at least of the financial character, and interpreting the result therefrom, according to American Institute of Certified Public Accountant. In a smaller and in a very simple definition of by American Accounting Association, accounting is the process of identifying, measuring, communicating economic information that permit informed judgment and decision by use of financial information. Now, if you take note of these two definitions, if we are to look at these two key terms, we can discover that the basic element or idea of bookkeeping, as we said earlier, is just to record the transaction. However, accounting goes beyond this. It will record it, classify it, and summarize it. Not only that, it also tries to interpret the result, also communicate the result to the users of financial information so as to make a judgment or a better decision therefrom. So what I want us to take note at this point is there is quite different distinctive features between these two terms. Bookkeeping is limited to recording of transaction, whereas the accounting is more than that by giving us the information that will guide the user of financial statement. That is the most important thing that we need to take note of at this point. Now, looking at it in a more specific manner, we might need to distinguish further between these two terms. In form of the scope, the stages, objective, the nature, performance, and relation, we can also say the skill also. We can also distinguish between these two. Take note, especially for the WAEC student, examiner often asks us to state or distinguish between these two terms. You can look at them from the scope. The scope of this bookkeeping is concerned with identifying, measuring, monitoring them, and recording them. That's the key word here in the book. Their own is to record. However, accounting has to do with communicating the result to the user. They will translate it, they will interpret the result, communicate the findings to the user in form of financial statement or what we call annual report. The stages of these bookkeeping is primary stages, i.e. is the beginning of the accounting process, whereas accounting itself a secondary stage. It begins where bookkeeping ends, i.e. the bookkeeping lays the foundation upon which we build accounting. From objective point of view, the basic aim of bookkeeping is to maintain systematic record of transactions, at least to give evidence that we have the company, not the external users. Whereas the objective of accounting is to ascertain the net result of operation and to give all the financial position and to communicate the same to the interested party. There's no communication in bookkeeping. Let's take note of that. The bookkeeping is not giving us the profit or loss, and it's not telling us the position of the company at the point in time. Rather, it only gives us the record. And there is no the only stakeholder here, if I may say, are the management of the company, who are responsible for preparation of financial statement. Whereas the stakeholder at this point can be known or unknown stakeholders. Whichever have anything to do with company fall within this category, like customer, labor union, creditors. These are the interested party here. Then the nature of job here is more or less a routine job. Therefore, if I also talk about the skill required under this, we might require a lesser skill. The skill required might be lesser here because the routine, everybody can do it. You don't need to even go to school. Once you can follow up the bookkeeping, you can do it. It doesn't require special profession. It doesn't require special skill. It doesn't require special training. Whereas in accounting, it's very analytical and dynamic. Therefore, it requires a professional. That's where you usually hear professional accountant. We have not heard professional bookkeeper, because bookkeeping is just a routine job that doesn't require the skill. You can also look at them from the skill perspective apart from the nature. Then performance, as I said, you can see, is mostly performed by junior staff, whereas this is done by senior staff in the organization. Then the bookkeeping is the basis for accounting. They are linked between them. Examiner might also ask us to tell them the relationship between the two. We cannot have accounting without having bookkeeping, because it is from where the bookkeeping ends that accounting begins from. So these are the basic differences or the meaning of these two words. I would like you to ponder upon these, because this serves as a basis of anything you want to know as far as accounting is concerned, even at any level of education. Now let's quickly relax more and look at the past question. These are the JAMB question for the UTME student. The examiner asked in May in Jan 2008, question number 1, that one of the major features of bookkeeping is that it provides the permanent record for all the transactions. It is futuristic in nature. It accepts the responsibility for all wrong posting. Do not give room for double entry procedure. The answer is A. We have not said whether I talk about double entry. No. It's possible you can also take double entry. By the time we do the double entry principle, we will know better. Accept responsibility for all wrongdoing, wrong posting. This is not the picture. Futuristic, no, because it's only deal with already past transaction. Therefore, it provides the record, the permanent record. When you keep the record, it will be there permanently for all the transaction. And this A is correct answer. In 2009, question number 3 also, the same jump. The process of bookkeeping includes record produced from. Actually, there are certain things we have not covered, but at least I will shed more light on this. From the bookkeeping, this is the elementary aspect. The primary job of accounting is from the source book, not from the ledger. Ledger is account, not from minute of the meeting. No, your meeting is not a monetary term. It's not from proper reasoning or our IQ. No, it's from the source book. What do we call source book? By the time we get there, we know more about source book later on. These are the book that, like invoice, receipt, these are what we call source book. By the time we get there, we know more about them subsequently. So the answer here is also B. That is source book. That is where we get our bookkeeping item from. Then in 2014, recently, 2014, question number 2, the examiner also asked, one of the difference between bookkeeping and accounting is that, as I told you, well, look at the picture between these two. The examiner is now asking us what's the difference between this. These are bonus mark questions. Once you understand this area, you can easily get your mark without and save some time, so some minutes or seconds that will guide you in dealing with the calculation aspect. That is why I believe we should start our lecture from this particular stage. Now, one of the difference between the bookkeeping and accounting is that the former, what's the former? That's the bookkeeping. Is former record data while the later interpret it. The former is regarded as a language of business, while the latter ascertain its strength. The former interpret data and the latter record it. The former summarize the information while the latter communicate it. Can we look at this? If you come back to what we have discussed here, one of the definition of this, we don't have anything like information here. It's about data. Therefore, if you come back to this place, the issue of information should be knocked off. Therefore, we are not the issue of information is not there in the first instance. So, therefore, we talk because there's no information regarding bookkeeping, but there's information regarding accounting. Then, the language of business is not bookkeeping, rather it's accounting. This one is also out of it. Now let's look at this. This one record, this one interpret, this one interpret, this one record. I think if you come to this point, we have discussed that the three definitions of bookkeeping we have here, all is about recording, recording, recording. Whereas when you come to this place, you see the word what? Interpreting, interpretation. This is where examiner took this question from in UTMA 2014 MCQ 2. So therefore, the answer here is also A. So this is just the way the examiner has been examining us in JAMB on this particular area. By the time we move further, we also see the way we have them in our WAEC exam. So before we move on, let's quickly look at the history, the origin of accounting itself. I only draw our attention on most important aspects here. There are quite a number of arguments in literature or in books that where does accounting started from. Actually, I'm not here to give you the details, because I don't expect the examiner to ask you. But the most important aspect of this area is that you must know that the double entry principle, or the double entry system of accounting or bookkeeping, starts from the man we call Luca Pacioli. So a mathematician, and he has a friend. Look at his friend there, Leonardo da Vinci. So this is this occurred in 1494 in Italy. So take note of that. So in case examiner want to ask you later, the basis of bookkeeping double entry principle is still applicable today in accounting world. However, it is old as 1494, and it was this man that developed the concept. We are going to look at this concept of double entry principle in more detail later in this presentation. So take note of that. The double entry principle, that's the basis of accounting. That is the system used in accounting. It was developed by Luca Pacioli, and is from Italy, and it happened in 1494. So since that day, or that time, we have seen quite a number of things that happen in accounting world, most especially the coming up of industrial revolution in 19th century, and the coming together of what we call a joint stock business, and the concept of issuing accounting standards. Like in Nigeria, we have Financial Reporting Council of Nigeria that is responsible for ensuring that the company apply the what we call international financial reporting standard, though that is outside the scope of this syllabus. But we must know that the managers of the company, mostly in a joint stock business, are the one responsible for the preparation of accounting, and the owner of the business will receive the report of stewardship from them. So as I said, the major component of this history I want us to take note is issue of Luca Paciolo. Now, let's quickly look at the what do we say accounting is all about. By the time somebody talk about accounting, what are the stages involved in the process of accounting? This will guide us. Anytime you hear the word accounting, you know what we are talking about. Of course, it started from transaction between two parties. Two parties here can be company to company. It can be company to company. It can be company to individual. It can be individual to company. It can be company to government. It can be government to company. It can be government to individual. It can even be individual to government. It all depends on the way transaction is and who is recording what. So when we say transaction is about two individuals, we should be able to know that this individual here is just for us to have. Transaction must occur between the two parties. If it occurs, the first thing you do is to collect your invoice, i.e. somebody want to buy, somebody want to sell. There will be need for us to exchange a document to justify the transaction in form of the quantity, probably the quality, the price, the date, the time, and the mode of delivery, and also the mode of payment. All these documents that we use at that stage is what we call source document. Remember, we come across source document last time. Source document, these are the documents we need at that point, and that is document we build. We prepare our bookkeeping, we keep our book on. Now, having done this, the next thing to do is to analyze this particular document. What I mean by analysis here is that you tell us the column of the transaction involved, the price, the date, who are involved, is it on credit or is it on cash basis? Then you record it down. Record it. Recording here is to keep, so that we able, this is what we call bookkeeping here. By the time you will record of the transaction, then you are do bookkeeping. So bookkeeping take effect from the source book, which are the all the original document, or what we call the preliminary document, or the document of evidence that shows that transaction has taken place between two individual, as I said, two parties. Now, having done this, the next thing we are going to do is to post from this record. You post to ledger account. We do more of this later on. We know how to post. What do you call ledger? What are the type of ledger? We know from there. So from ledger account, we prepare what we call a trial balance. A trial balance is just a statement that shows the arithmetic accuracy of the ledger. Ledger take effect from the bookkeeping. We have the ledger. From ledger account, the word account starts from here, whereas at recording stage is all the bookkeeping. So at this point, accounting started. So we prepare this one to be able to see whether there is an error here. If there's an error at this point, then the balance here will not be equal. But if there is an error, then the amount here must equal to the amount we are going to see here. Then from here, if there is any error, the next thing to do is to adjust for that particular error here. We do the adjustment here by what we call a suspense account. We are going to see detail of this as we move on. So having done this, then we prepare our final account. The final account is a way of communicating whatever that happened from this point up to this point into the users. We communicate them to the users of the company, of the account. The user here can be owner who want to see whether there's a profit or loss. Users here can be government who want to collect the tax. Users here can also be employee who want to agitate for minimum wages. The users here can also be debtor, those that own us or we own, that we want, that own us. It can be creditor, those that we own. So a lot of stakeholders are here that we must put in their interest by the time we are preparing our final account. And basically, final account made up of profit or loss account. Please, it is not profit and loss. Let's take note. It's a fallacy to say, or is very wrong. It's very wrong to say profit and loss. You cannot make a profit in a year at the same time still make a loss in that particular year. So you either make profit or you incur losses. Then at the end of the day, you tell us the statement of another position of the company. This one will tell us the asset and the liability of the company at the point in time. So this is what account is all about. Actually, at this stage is just to have the idea. We will now take them one after the other and do more analysis on each and every one of these particular concepts. However, before we get there, let's quickly also take note of these important nature of accounting. By the time we come to today, we are hearing somebody's an accountant. I'm working as an accounting officer. I'm working in an accounting firm. What do you, when you say accounting, what should come to people's mind? Accounting is service activities. It's not a manufacturing business. It's a service. We render a service. Accounting job is a service job. We keep record. We provide a service. We a kind of auxiliary to the business. We keep business alive. And accounting itself is a professional. That's why you'll be hearing professional accountant. If you finish maybe you graduated from university or polytechnic, you are just an accountant. You are not a professional accountant until when you are able to have your professional qualification, like your ACCA, you have ACA like ICANN, you have CIMA, Certified Institute of Management Accountant. Then you and some other body, the exam like that gives you to be accountant. So that's only when you become a professional accountant. Then accounting is also a social forces, i.e., it provides a kind of it provides a social welfare, because you as an accountant, you are the one that hold the company lives. So you are to provide a social service to the people. If you manipulate the figure, you can easily cause a lot of problem. If you fortify the figure, you cause a lot of problem. You cause a lot of social harm in society. Therefore, likewise, account is a language. It's a language of business. Let me give an example here. If you are working as an accountant in a company and your company made, let's say, 10 million naira as a profit. 10 million naira as a profit. It will be wrong for you to say this year we make 10 million. No, there's a language here. Just tell us maybe your total capital is 100 million. Then you tell us that you make 10%. It's clear. Nobody know what 10% stand for. So you communicate from using accounting to communicate to the users. It's a language that people want to hear. The investor want to hear it, the creditor want to hear it, the government want to hear the language, the government agency like Federal Revenue Service want to collect the tax, they want to hear it. If you are working in a bank, if you are a banking business, the CBN, Central Bank of Nigeria, want to hear it. This is why we call it the language. Then accounting also is a science, because it tells us there are rules and regulations that are guiding what to do. For example, I must debit this one must be credited. I must debit this one must be credited. This is a science here. You can't reverse it. It must be like that. Or it can also be an art. There are certain things you can do as a management of a company that, okay, we want to add this to make things more easier to the user of financial statement, or we want to remove it. So here there is a little flexibility here. When we say something is art, it is more flexible. But when we say something is science, it is more rigid. So here relevancy is most important thing. We are going to do more of that later on. Here reliability is most important thing also. Then accounting is also an information system. Information system is also a way that it is a complete system. You can see here, it's a system that moves from here like this with interrelated activities, from invoice to recording to journalizing to legalizing to trial balancing to adjusting to preparation of financial account, and to also start again. So it moves like this in a circular form. That is why we can call it an information system. Information moves from one stage to another stage. From when you get raw material, or you borrow money, or you put your money, you get raw material, you transform to the product, you take it to market, you sell it on credit, you get your money back. There will be interrelated activities here. That's what we say is an information system, and it really help. So if examiners will ask you to explain maybe the nature of accounting, these are the things they want you to give them. Then next is to look at the objective and the function of accounting. In fact, just to summarize what we have been discussing since the beginning of this presentation. One of the objectives, or what we call a function of accounting, is to maintain a systematic record of financial transaction of an event. Event is something that occurs between two parties, and their particular event should be in form of monetary terms. So once that event occurs, either selling or buying or contract, then there must be a record. This element is more of bookkeeping that keep the record here. Now, you must be able to, it's a systematic way of doing it. Systematic means is already have a way of doing. Debit this, credit this, add this, less this. Then accounting also help the company to ascertain profit or loss at the end of the year. By the time you start your business on 1st of January, let's say 2015, and you close all your book in 31st December 2015, then somebody want to ask, how far have you gone? The meaning is it a profit for that particular year, or you incur loss? It is only from accounting we're able to know that. Then financial position of the company, i.e. the company want to know, or the users want to know, what is the available asset of the company and what are the liability the company is also having at that particular year. Then it also assists management. It assists management in so many ways. One of them is that to communicate accounting information to the users, because management prepared the accounting record, and when they prepare, they are not mostly the owner of the business. Take note, in your economics class or in your commerce class, you might have learned that in a joint stock business, the ownership of the business is different from the management. So the management is responsible for preparation of accounting or financial information. It is from this accounting process or system that the management will be able to tell the user, the owner of the business, that this is what I have done from beginning of the year. These are your assets you gave me, this is what remain, and these are the income I've generated for you, and this is other obligation you also need to pay. So it is the accounting system that will guide us to be able to know all this. Then from accounting, we also be able to maintain systematic record of all all the activities of the company, to communicate financial results of the company, meeting the legal requirement. For instance, there might be need for any company that is listed on the that registered by Corporate Affairs Commission in Nigeria, CAC, to file the return to the CAC at the year end. Is a legal requirement. Therefore, what they want you to know is to give the CAC the account of the company. So if there's no account, then you won't be able to meet up with that legal requirement. Apart from the legal, you can also have what we call regulatory requirement for the listed company on the floor of Nigeria Stock Exchange. You are to give them your annual report, that is Nigeria Stock Exchange, if you are listed on the floor. So that is what we call the regulatory, because the Nigeria Stock Exchange or Security and Exchange Commission of Nigeria, SEC, is not a legal issue, it's a regulatory issue, rather than CAC, that is a legal requirement. Then accounting also guides to protect the asset of the business. You'll be able to know what are the company assets, how many vehicles do we have, how many buildings do we have now, unit of computer we have, how many machines we have, do we still have the equipment. So we're able to see using the financial statement, then assistance to the management, and provide the stewardship report. So any of these points can be taken to be an objective or the function of the accounting. So I want to enjoin you to take note of this. You can also add other things. Once you understand what the accounting is all about, you can also add things, because the exam, you don't need to memorize, just need to understand. Once you understand, you can easily write what comes to your mind. Then the merit of accounting. In fact, we can take from the previous slide, but I just want to be specific here, that we're able to know most of the points we have mentioned as a function can also come as the merit or the advantages of accounting. One of them is financial information about the business. We have discussed this. Assistance to management, you can discuss it. Replaces memory. Yes, instead of, you see, if you don't record your transaction, that you want to be keeping them, and you want to memorize, yesterday I sold something to somebody, today I just sold, tomorrow somebody promised to come and buy, then from January to December I don't want to put anything in paper, or I don't want to record it in the software, then I want to memorize it, then there will be a problem. You have a missing figure, you are going to miss transaction, and your account will not be adequate, and your information will be what? Will be deficient. Then facilitate comparative study. If I have account, I can easily compare, for example, the performance of, let's say, First Bank Nigeria PLC with Guaranteed Trust Bank in Nigeria. I can easily compare these two companies using their financial statement. Without financial statement, I will not be able to objectively compare them. I can equally do what we call trend analysis. That is the First Bank 3 years ago, the First Bank last year, and the First Bank this year. So this is one of the important and the advantage of accounting. Then it also help or facilitate the settlement of tax liability. I told you the Inland Revenue want to see your accounting record in form of your filing return to them. So you're able to know, to guide you, how much am I going to pay as a tax liability, because you pay tax on income, not on the capital. So if you don't have record of what you sold during the year and what you have also bought during the year, you won't be able to give record of your own profit. You may end up be paying income tax on capital instead of paying on the income. Then a facilitate loan. Another thing is, if you want to go to bank to go and borrow money, the bank manager or the officer in charge of the loan will also ask you to give them your financial statement, your accounting record. Therefore, you need this to also get this particular opportunity to finance your business. Then evidence in court. This is peculiar to those that do forensic. today accounting is moving from just a manual accounting or historical accounting to a new aspect we call forensic accounting, though it's outside your own syllabus. But who knows, examiner can ask you. A forensic accountant is a person that prepared the account, or they prepare the account in such a way that that account will be used as an evidence in a court of law. You have been hearing it. We need a forensic accounting to determine the amount looted by some people or the amount stolen by some people. We need a forensic accountant to do this. These are special skills. If you become an accountant, you can specialize in this particular area. Then if a company want to sell or want to merge to another company or want to discontinue the operation, accounting record will also tell you your value. What is your value? Then you'll be able to sell the company properly. Another thing that will serve as a benefit of accounting is in the point of liquidation or insolvency, is also help assist in carrying out the liquidation or bankrupt as the case may be. And in form of partnership, it also help the partner to really take care of what due to each of the partner. We are going to do more of this thing details, just a preliminary explanation of what we need to know as per the benefit, significant, important, advantage, merit of accounting in the case examiner asks us. Now let's quickly look at the accounting information. We have been talking about this. Accounting is to provide information to the users. According to the Accounting Principles Board, accounting is a service activities. Its function is to provide qualitative, please take note of this, qualitative, primarily financial in nature, about the economic entity. Here is we are talking about firm or company here, that is intended to be useful in making economic decision. That is most important thing. As an investor, you need to get the annual report of a company before you buy the shares of that particular company. That is what the accounting is trying to do. And basically, we have three main components of this account that is important to the users. One of them is information relating to profit or loss, not surplus, please, or loss. Or you can say surplus, but let's say profit or loss. Are we making profit? Do you put your investment in a company that is not making profit? Then I need to know information about this particular company over the year, whether it has been making profit or loss. Then information relating to financial position of the company. I want to know the asset of the company. Are they old asset or the new? Or the asset, are they all out of fashion? Or as technological advancement overtake the importance of this particular asset? For example, do you buy a company that have mainframe computer and put your money there that yes, our company has a very big asset, and when you get to there you see mainframe computer that also require a very big generator to power it, whereas you can also take your palm top to carry out transaction that the mainframe computer will do. So what we are saying is that the asset of the company need to be considered, and you can only get that one from the answer position. Then also the issue of cash flow. Is your company is liquid? There are companies they are not liquid. Of course, this one is subjective, but at least at this level, just take note that these 3 points are very, very important to the users of financial information. Now, who are those users? Please let's take note of this particular point, because we are going to look at the users here. The users has been divided into 2 in the textbook or in the literature. One is internal users, the other one is external users. Please take note of these. Who are the internal, who are the external? At the same time, I will try as much as I can to explain to you what this individual needs from these 3 documents. These are the documents we need basically. Profit or loss account, financial statement, what we call balance sheet. For some of us that we are still we are just coming up, some people call them balance sheet. Please, you can call them balance sheet also, but mostly they are being called financial position of the company based on the latest terminology. Now let's start from the internal. When you say internal, these are users of financial statement that also work inside the company. They are involved in the company. They are, when you say internal, it's like when you say a family, you have a family. Family has internal. When I say we have immediate and extended, you can call some of this immediate family and extended family to be extended to be external. This one are internal. They are all stakeholders. They need one or two things from the company. But internal are those group of individuals that are involved mainly in decision making in this particular company. They are involved in decision making in the company. Now, one of them is owner of the business. Of course, if I have my business, owner, I know what to do. Probably I start my own business myself. I run it for maybe 3, 4, 5 months before I even engage anybody. I'm internal to the business. Then, of course, management. Management are those that are doing business, run the business on behalf of these owners. And with these people, they are interested in asking for more bonuses. They want to see company giving them bonus based on performance. There are companies today that give the management to travel abroad for their end of year retreat based on the performance, based on the profitability, based on the cash flow, based on the financial position of the company. Likewise, if you look at the employee and workers, let's put these two together. Employee and workers are more or less the same thing, and with labor union. These are people that work on day-to-day in the business. They also want to see what happened to the profit of the business. If the company they are working for are making enough profit, they will be able to ask for more wages. They will be able to ask for a better working environment. They will be able to agitate for a better environment, a conducive environment for them to be able to do better. Therefore, these are internal people. These are their needs. These people are talking about salary increment, improve in bonuses, increase in leave allowance, and some other allowances, and so on and so forth. So these are the internal. The external are those people or group of individuals that interact with the company one way or the other. Here is bank and financial institution. They borrow or they lend money to the company. They are not involved in day-to-day activities. However, they have stake in the business because they loan the company money. They want the company to be liquid, to very good in cash flow, so that by the time they want to collect their money back, the company is not complaining that you see, I have to sell this building before I can pay you. No, they are interested in liquidity. Are you liquid? Where's my money? When you say come tomorrow, I must get my money tomorrow. Don't say come tomorrow. When you come tomorrow, say come tomorrow. Then tomorrow become tomorrow, and tomorrow carry on become tomorrow. These are problem of what we call liquidity problem. We are going to do more of that later on by the time you come to other topics. Then investors and potential investors. Investors, mostly they are very related to the owners. Investor is when we talk about those that are a kind of a joint stock business, where some people are shareholder, some are shareholder. They are not even involved in business daily. Let's take the difference between the owner and maybe when we talk about sole proprietorship or partnership. These are owner of the business. But when you come to the PLC business, that's a big business like First Bank in Nigeria, PLC. They are investors. Their shareholders are not the one doing the banking business. Therefore, they call them investor. And the potential investor are those people like you and I that still want to invest. We don't have investment yet in these banks, but we have intention. But when we have enough saving, we can invest in this company. These are the people we refer to as investors. Then we have creditor. Creditor are those that supply goods to company on credit. We call them supplier. Examiner can also call them suppliers. Please take note of that. You supply goods, raw material to the company, and the company promise to pay you next month. Then you are a creditor. Then government and its authority or its agency. As I said, in Nigeria, we have the issue of Federal Inland Revenue Service, we have the CBN, we have DMO, we have Security and Exchange Commission. These are government agencies that are also stakeholders. Then we have researchers. Those are the people in academic or in a research institute that are working to develop some innovation or invention that will guide the company in using a new business model. So these are the people we want. Their customer. It is you and I that we are consuming the product of these people. You know, we are consuming their product. If for example, if the Nestle produce a poor product or a very damaged product, then we might need to take them up and run away from their product, and they might close business. So we are stakeholder. We have some customer that are major customer that they can, even when they sneeze, the company must cash code. So these are things that we need to take note of. The interest of these people is that the company should produce the adequate product, or can I say the quality product, that will not be harm to their health. Then the public as a whole. The public here can be immediate environment where the company is working. Like for some of us that we are very concerned to the Niger Delta area in Nigeria, you discover that we are talking about oil spillage, gas flaring. These are things that is causing a lot of agitation here and there. Therefore, the community there, they are immediate community. Then there are also public. When we say public, also a remote community also. So it all depends on what we are trying to say. So just take note of what these people require from the company and how company should try and take charge of their something. So I will leave you on. You take note of some of these example also is for you. I've told you, I've done mine. You can also look at it. I have two questions here. This one is UTME 2013, question number 2. The accounting information seek to, you must be able to tell us the correct answer here. We have the option to permanent record, analysis of record. You can also, we have seen a question like this before. Then also we also have another question 2010, the question number 1 also. Examiner also say which of the following is not an external user of accounting. We just explained them. Which one is not? It's not an external. Is it government, external, shareholder, creditor? Who are not the external? You'll be able to discuss that when you pick the correct answer, and it will give you the you know whether you get it or not. Now we move on to the next aspect of this note, that is to look at the qualitative characteristics of accounting information. Please take note of this. Very, very important. Examiner will ask us to mention them, to discuss them for UTME student as well for WAEC student. But for UTME student, examiner can just define one of them and give us and ask us to pick the correct answer. So I want you to listen carefully, so as we want to discuss this particular topic properly. Now, if you look at this, when we say financial information should be reliable, what are we trying to say when we say reliability? What we are trying to say is that reliability is all about ability of this to be replicable. Let people feel comfortable with it. I can rely on it. The major thing here is, if you prepare your account, maybe A company prepare its account, B company prepare its account, then follow the same accounting rules and regulation, then they must have the same outcome. The outcome must be, it's not, I'm not saying when you say the same outcome, it's not like they have the same profit, but they should follow the same systematic way of doing it. That's the key word. That's what we call reliability. Everybody know you can't start account from final account. Rather, you start account from the bookkeeping. Bookkeeping is the first thing you do, just to get the invoice, put them together, and from there you go to ledger. From ledger you do to trial balance. From trial balance you go to adjustment. From adjustment you prepare profit or loss. From then you prepare balance sheet. This is what we call reliability. Everybody knows the system involved. That's what we call reliability. However, when you talk about relevancy, is that the information you are giving in that particular accounting must be relevant to for decision making, because the purpose of accounting information is for us to take informed decision. For example, if what you have in your account is a lie, then that particular information will not be relevant for decision making. So ability of your information to influence our decision, that's what we call relevancy. Then the next point is understandability. That is, it should not be ambiguous. The accounting information should be very clear that even everybody who lay his or her hand on that particular information should be able to read and understand the information without much stress. You don't need to look for a kind of expert to be able to know that this company has made profit this year. No, you don't need to look for expert for me to be able to know the company is not doing fine over the last 3-4 years. It should be very clear. The language should be simple that everybody should be able to interpret, because it will also cost investor more to go and look for interpreter who also will charge them some fee before they will interpret the result for them, and they will spend more money to invest. So if your own account is not well prepared, people will not be able to know how to read it, and if they don't read it, they will not be able to invest in you. So it is expected that when you say accounting information should be understandable, it doesn't mean that everybody, at least the interested party, should be able to take it, read it, digest it, and make relevant decision therefrom. Then another thing is that it should be comparability. It will be comparable. As I told you last time, I can look at the performance of two companies. For example, the bank A and bank B. I can look at the performance of, let's say, Northern Nigeria Flour Mill and Nigeria Flour Mill of Nigeria. You see, I can look at the performance of Asaka Cement and Dangote Cement, because these are two companies in different areas and in the same area, and I should be able to look at their performance. So it is this particular point that guides that particular analysis. I can look at them. What I have here, I should be able to look at the comparability. Apart from these four, there are other points that we might need to take note when it comes to the issue of qualitative features of this financial statement. Let's put them here. It should be timeliness. That is, it should be prepared in time. It should be timeliness. It should be prepared in time. These are fundamental ones. We have other ones. One of them, as I said, is timeliness. The account is covered a particular year. You cannot prepare account to say over 20 years. Rather, in accounting, the accounting period is normally taking care or is over a 12-month period. That's a year. It should be timeliness. Then also, we can also say it isn't cost. It should be it should not be costly. You look at the cost. It should not be costly. Costly to the preparer also, because if it is very costly, it also reduces the profit accrued to the owner of the business. So these are things that we need to take note when we talk about the quality. Please take note, qualitative characteristics of this financial information. Now, having done that, then let's look at the system of accounting. We are going to look at this in detail later on. But as I told you, I said Luca Paciolo developed double entry principle, and this is basis upon which we prepare account. We also have what we call a single entry principle. When we say this one is double means two, dual. It involves two. Here is only one. Under the dual, that is, for every transaction, I must have two angles into it. One angle will be left and right, left side or right side, debit or credit. We are going to know the meaning of this as we move on. But for the single entry is the system of accounting that doesn't follow the double entry. Rather, whenever I only record one thing. So here I'm going to have what we call incomplete record. All these will be discussed later on. But we have these two, and I want us to remember that accounting system can follow either of these. We are going to look at the benefits and the otherwise of each of them as we move on. Now, the principle, concept, and convention. These are also very, very important, and I will also like us to listen to the explanation. There are concepts that guide the way and manner we prepare the account. There are concepts that guide the way and manner we prepare the account. And there are principles and convention that also we need to take note whenever we are preparing the financial statement or the account of the company. We shall look at them briefly here, and we'll be making reference to them anytime we need to use any one of them in the course of our lecture. Now, the first thing is what we call entity concept, or we call separate business entity, or otherwise you can even call it entity concept. The meaning of this concept is the business is different from the owner. That is the meaning. Business is not equal to the owner. I.e., if I start a business with social amount of money, even if I'm the owner of that business, it's as good as if I'm borrowing the business money. So business also owns the owner money. Therefore, I must open an account in the name of the business, not in my name. The business will pay tax in its own name, not in my name. The business will enter into transaction, into contract with people, with the stakeholder, with other party, in its own name as a business, not in the name of the owner. So this is what we call entity concept. Another concept is what we call money measurement concept. Here, whatever that is going to be recorded from bookkeeping and accounted for in the accounting process must be in monetary terms. I must say, okay, I bought so amount of money, 20 million naira, 10 million naira, 4 million naira. If I say A bought goods from B and I kept quiet, then what do? I cannot record anything as far as that thing is concerned, because I will ask question, how much? So it must be stated in monetary terms. That is what we call money measurement concept or money measurement concept. Then dual concept, I've told you just in previous slide that it's based on double entry principle. We are going to do more of that as we move ahead. Then going concern concept, the meaning of going concern, as the name implies, going, meaning something that is going, that is moving. That is, it is expected that company should continue to exist into a foreseeable future, or we expect the company to continue living over and over a year. But when you define this going concern, the meaning is that when you look at the accounting information will be prepared in such a way that we still expect the company to cover the next 12 months. That's what we call going concern. It is not in perpetuity. Please take note of this, because people mistakenly take going concern as company should be in existence in perpetuity. Nothing will be in existence in perpetuity. The meaning is that the company should be in existence in the next 12 months. Please take note. Some textbook, you see it there, they will say the company should be in existence in perpetuity. I said no. The meaning is the company should be in existence over the next 12 months or 1 month or 1 year. Please take note of that. That's what we call going concern concept. Also, we need to prepare the accounting information based on period, or what we call periodicity concept, or what we call period concept. The meaning is that there should be the period we cover by our account. By the time we come to the real account, we are going to see, they will tell you that profit or loss for the year ended 2015, for the year ended 2014. That means that there must be the beginning and end of the year. So it must be 12 months, depend, but mostly it's 12-month calendar. It's the 12-month calendar year that we call a period. So when you hear the word periodicity or period concept, is that the company should be in account should be prepared in such a way that the company should be the period under investigation or under reporting is 12 months. Then cost concept, what we call historical cost concept. You can also call it historical cost concept. Here the meaning is the accounting information is prepared based on historical cost. Historical cost is the original cost of an asset. For example, if I'm in business, maybe I started a business in 2010, and at that time I bought an asset. Let's say I bought it at 5 million naira. 5 million naira made a particular asset. It is expected that every year in my account I must be taking this asset as 5 million. Then I will remove depreciation. So I will be carrying the value under the what we call non-current, and what we call a fixed asset. Let me use the word fixed asset at this stage. Fixed asset at 5 million. So that initial cost of the asset is what we are going to be seeing in the record. We call it historical cost concept, what we call a cost concept. Then matching concept. Matching concept is you match the revenue of this year with expense of this year. You don't prepare account and you are going to bring the income of 10 years ago and come and put it in the record it or account for it in this year and say this year we have done better. No, the income of this year should be matched with the expenses of this year. Then we refer to as matching concept. Then accurate concept is that this more or less applicable or very close to the matching, but accurate concept says that the income should be recognized when it is earned, when it is deemed to be earned, either if you have not even received the money. If you, for example, sell product on goods sell goods on credit, once the buyer accept, though they have not paid you, you record that you have made a sales. So your revenue will be recognized at that point. That we call accurate concept. The opposite of this one is what we call cash concept, cash basis. We don't use it in a private sector, but we use cash basis in a government account. So also, of course, if I also bought something on credit from somebody and have not paid, he must have received goods and I acknowledge the receiver of that particular goods, then I will record it as purchase and also create a creditor account. So it's not when I'm going to pay cash or receive cash that I'm going to record. I will record only when this has been good has been taken care of, either whether I've received the money or I've paid the money. That one is irrelevant at this point. So the last concept is what we call realization concept. Here is that I must be realist. I must be very, very prudent. I should not be overstating profit. I should not be anticipating profit. I should try as much as possible to anticipate loss rather than profit. I should only record profit only when profit is very clear to be earned. But I should also try as much as I can to really provide for losses only when I'm seeing it coming. So under this realization concept, you want us to prepare the account based on a concept of prudency. That is what we call realization concept. So we can now understand what these concepts are all about. Anytime you want to prepare account, you must hold to all these concepts. Then the next aspect of this is what we call convention. One of them is consistency. Consistency means I must continue with a pattern of accounting over a reasonable period, or a method of accounting, or a system of accounting. For example, we are going to learn something about depreciation later on. You remember what we call a straight line method of depreciation. Straight line method or depreciation. So if I'm using straight line method or depreciation, I must hold on to this method over the year. It's not like last year I'm going to use straight line. This year I want to use another method, or that one I want to use another method. No, if I'm using this particular method, I must be consistent with it. So any method, any principle, any concept, any opinion I'm going to use in preparing account, I must hold on to it over a reasonable period. And if there's a need for me to change, I have to state categorically why am I changing. Then conservatism is very close to realization concept. We have to be conservative. Accountants should not. That's why when people say accountants, they are very stingy. No, we only conservative because we don't want to be a kind of extravagant in doing things. We're very, very careful in doing things. We're very, very realistic in doing that. What we call conservatism. Then materiality. The meaning of materiality is we should try as much as we can to only account for items that are material. For some of us that we have read books like Frank Hood and Omuya, you remember, you hear the word sundry cost or sundry expenses or sundry creditor. Sundry expenses, these are expenses that on their own they cannot stand as an expense. But when you put them together, you now name them sundry. Sundry is a kind of a group of expenses that they are very small on their own to stand alone. Because if you want to create account for all the items, for example, do you create account for pure water account, razor blade account, broom account, toothpick account? These are things you can just call them office expenses. You know, under office we have so many things that involved because they are not material. But if I have motor vehicle, I also have machinery, and now put them together and say something. No, machinery is material on its own. It can stand as an account. That is what we call, what we refer to as a materiality. Equipment will stand alone, is material. Motor vehicle will stand alone, is material. Office furniture will stand alone, is material. But when I say pure water account, because I used to take pure water, or I used to buy a razor blade, or I bought a toothpick, these are office expenses or sundry expenses. So those are immaterial. So we should prepare account based on materiality, i.e. we should account for items that are material. Then the immaterial items should be grouped together. It's not like we are going to ignore it. Please take note in your OBJ. Examiner can just say the materialism means the immaterial item should be ignored. No, not to be ignored, is to be grouped together into a group, into a new account, and give them a name of interest to you. So let's quickly look at the past question here to see how far an examiner has also has gone. What we do here is to pick one or two examples. You can also lay your hand on past question and read more of them. Now, the first one also comes from question number 2, 2008 JAMB. Which of the following accounting convention suggests that accountants should use the method of valuation that understates rather than overstating result? Conservatism. I've told you we should prudent. That's just the answer. It's not historical. I've told you it's not historical. It's not monetary. It's not cost. It's conservatism convention. The accounting convention, we state that performance of the business should be determined by matching all the expenses against all the revenue. All the expenses against revenue is what? Periodicity? No. Objectivity? No. Materiality? No. Materiality say what? Objective is not part of it. What is not part of it? The answer is accrual. Accrual means you should match them even when you have not paid. Then UTME 2014 question number 3. The concept which states that revenue should be recognized as at when the sales is deemed to have been made. Is it going concern? No. Matching? No. Consistency? No. When by the time you pay, you realize that it has been deemed that you have sold the goods, then you take it. So the answer is C. So these are the way. That is why we took our time to explain to you. Please listen very well and also take note of other question in your past question. We only pick this one for your understanding. Now we move next to the next topic, the next concept, that is double entry principle. Double entry principle or accounting, I've explained. What it's saying is that for every transaction there are two sides, debit and credit. What do we mean by debit? This is what we call account. This is what we call a ledger. We are going to see more of it. This side we call left side. Here we call right side. We call debit side. We can also call it debit. Examiner, at times you see some book they put DR. Here they see credit. So a system used to analyze and record a transaction, what we call a double entry. An entry on the left side called debit. An entry on the right side is what we call credit. This is what we call a double entry. So we are going to see when do we put on left, when do we put on the right. This one we do it later on as we move ahead. Now, the next thing we need to know is that this particular double entry principle has its own concept that we are going to consider. One is based on the principle of separation of entity concept. I've discussed this last time. The ownership of the business is separate entity to the business. That is what we need to take note, even if it is sole proprietorship. That is a basis upon which this particular principle is built. Then it's also based on accounting equation. We are going to do more of accounting equation later on. One of them is that the accounting equation said asset of a company can be acquired from the owner's contribution, we call capital, or from what the owner borrowed, we call liability. So asset is equal to capital plus liability. Please take note, this is the fundamental of double entry principle and the basis upon which you prepare your account. Asset of a company, either the one I bought with my money or the one I borrow money to buy. The one I borrow money to buy, it becomes a liability on me to pay. But here it's not a liability per se, but it's a capital. Therefore, here will be a creditor, here will be an investor or the owner. The two together must equal to asset. Asset can be defined an item business owned to help them trade. It can be cash, machinery, vehicle, stock, trade receivable, and so on and so forth. Liability, amount owed to another party, loan, overdraft, mortgage, trade payable, and so on and so forth. Capital, amount owned by the business to its owner. Please take note, the money not to the third party is what you own to the owner, the business owned to the owner. That is the owner contribution. And the next effect of principle of double entry is dual effect. Each and every transaction undertaken by a business has two effects on the business. Please take note, this is what we call dual effect, what we call double entry principle. Now let's take note of this. Let's move further and see what we have when we say about at this point. I would like us to please exercise patience and listen carefully to what we are going to discuss, because we want to start building gradually. We have the dual effect. We have three examples here. Capital, setting up a business using 20,000. Let's assume somebody and purchase goods for sale 1,005, and an asset, a new computer worth 850. Now these three items took place, assuming that this one, somebody start a business with this capital. Look at the effect. One, the money will be paid into bank account. Bank will open its own account in its own name, and the business own an outside entity, that is owner of the business, 20,000. So this is what we call a dual effect. Business will open its own, in the business account, we put the money there as a bank. Then I say, who bring the money? The owner. I'm owing this person 20,000. When he buys goods for resale, it will also have purchase account, and the money will pay out of cash book. When he buy computer has come in, we have an asset called computer, and the money in the bank account will also reduce. So this is what we call a dual effect. As we move on, as the company continue adding, if you bring another money, it will increase the bank. It will also be in form of either owned to the owner or owned to outsider. Now let's quickly look at the basic things here. This one will serve as a principle. These are the accounting elements. Once you talk about accounting, you don't need to know more than this. This is what all accounting is about. It's either you talk about asset, you talk about expense, you talk about liability, owners, capital or equity, or you talk about revenue. So on which side is an increase is recorded? If asset is increased, you put it on debit side. Please take note of these rules. I have an asset. If I bring more, you have already told you what we call a debit side. Look at debit side here. This is my debit side. This is my debit side. My debit side is here. So if this account here is an asset, let's say it's a motor vehicle account, for example. Let's assume that this is a motor vehicle account, and it's a motor vehicle, which is an asset. If I bring more motor vehicle, it will be on the debit side. That's the meaning of this. Now, if the motor vehicle reduce or decrease, it will be on credit side. That is, it will be on this side. Maybe as I dispose of one of my motor vehicle, then I will come and record it here. So as an asset, if it increases, it will be on debit. If it reduces, it will be on credit. So that should give us the basis when we talk about debit and credit here. Now, the next thing is an expense or expenses. If expenses also increases, it also go on debit side. If it decreases, it will be on credit side. Please, these two go together. They follow the same pattern. Asset and expenses, they follow the same pattern. So if I pay salary, I will debit salary account. I will ask, I pay through cash or bank. If it's a bank, I will credit. I will, and if salary is increased, I will also debit. If it decrease, I will credit. Now the liabilities, this is what I'm owing to third party outside the company. If it increases, I will credit it. If it decreases, I will debit it. Reverse of what we talk about asset. The same thing also owner's equity. If it increases, I will credit. If it decreases, I will debit. Likewise, revenue. So anything you want to talk about in account, it must fall within these 5 items. For example, if you say salary is under expense. If you say overdraft is under liability. If you say sales is under revenue. If you say commission is under revenue. If you say equipment is under asset. If you say rent is under expenses. Transportation is under expense. So just mention anything. It will fall under any of these 5 items. This is what we call accounting element. Please, I will want us to take note of this properly and follow the rules. Please, you can pause and listen to this particular point because it will provide a guide for us. Now, having learned this principle, that we now look at the benefit of double entry principle. It provides information about entity, about the company as a whole, that we're concerned as a whole. It is possible to evaluate operational efficiency of the company. It will help us. Concern here means company or firm or organization or even individual that is operating as a company. Then it helps to ascertain the profit or loss by preparing profit or loss account and balance sheet. Accuracy of accounting record can be verified by preparing trial balance. These are the benefits of this, because it is from double entry principle that we develop, especially when we are doing ledger. The system help us to know the financial position of the company. You can see for a particular period either your asset, your liability, and another thing. It provides information for meeting various legal requirements. And you see, if one is very, very flexible, all these points is what we have mentioned before. It's just for you to be able to bring them back. As I said, you don't need to memorize, just understand. You'll be able to explain vividly. Then the value of asset and liability can be known at any time by preparing the balance sheet. So that is the concept. So let's quickly go through some of these examples. I'm not going to go through them. I give them a lot of things just to explain to you what we need to know. Unique is a company sold goods for 12,000 to us. That is, we possess goods from Unique, and we are the one prepare the account. How do we put it? How do we put it in journal? How do we record it? How do we post? Which account do we post it? The meaning here is that we bought good from Unique. Unique sold good to us. and we want to put it. One, we bought it on cash. Are you okay? If we bought it on cash, look at the treatment. Because we purchase, we are going to open a purchase account, we debit it, and our cash account will reduce with credit. Here is a form of asset. Purchase of goods is increased. Our other asset, cash, we used to pay, it reduce with credit. Please, can we go back here? When we bought the goods, two things has happened. Our goods, we have received goods, asset increase, we debit it. At the same time, our cash, which is also part of asset decrease, we also credit it. This is what we call double entry principle. Now, if we bought it on credit, still our purchase has also increased, because either on cash or credit, it comes to us. However, if it's on credit, we have not paid. It's a liability. What happens to liability if it increases? We credit liability. Look at it here. Now, Unique here is a creditor to us now, and we have owed him 12,000. So it increased. Our liability has increases. What we will do with credit. So this is how this information will go gradually. Receive due. We receive certain amount of money from Score Booster Limited. Sorry, Score Booster, maybe it's not this one, or maybe it's the one. Maybe already we sold the goods to them. So Score Booster later on, before, and Score Booster give the money back to us. So when he pay us, and he give us we give him a discount of 10%. Take note of that. You can imagine 10% of 50,000 is 1,500. Therefore, what will come to us is 13,500. 35 will come to us. We come to 13,500. Then the discount account will also be debited. Then the Score Booster account will go. That means that we no longer we no longer before it's a debtor. So we are going, it's a debtor before, because it's owing us. Then this debtors and assets is also credited here, and that's how this item continue. So you can continue going through this one, also read it. Then let's also look at the past question of the examiner in 2013 in UTME exam. We have question number 4 and 5. In January, the person started the business with 10,500 naira. Now we are asked, the double entry for January will be capital. He brought the money, started with this money. It will debit what? Cash, and credit capital. That is it. So capital will increase because we brought the money in. So cash account will increase. So this answer is correct. See. Then we pay agro machiners 6,000 owing them. We pay them. It's our creditor. When we pay, what happened to their account? The account will reduce because it is a creditor to us. When we pay them, if reduce, it's going to debit, and our cash will also reduce. So this is the answer for this. So you can take other one in 2014 also in UTME 2014. Examiner also asked question which I will also like you to take note of it. And as I said, I have other example that you can equally follow based on one of the assumption of double entry theory is that you read through, you get your answer. Double entry principle of accounting was developed, you see, by who? This question was 2005 JAM. Then 2005 also, the concept that has most influence over asset valuation, we also need to look at that one. So I've given you all this so just for you to be able to appreciate the meaning. Now for those that are doing WAEC, in June 2011, the examiner asked us in theoretical way to explain what we really mean by single entry accounting. State 2 characteristics stage 3 disadvantages. So these are the suggested solutions. You can equally go through them. Then also in November 2014, question number 3, the examiner also asked in the WAEC exam, the examiner also asked that an experienced bookkeeping has failed to maintain full accounting record. The stage 3 ledger, of course we have not done ledger, but we are going to do it later on. Explain 3 disadvantages of business with incomplete record. Of course, if you take a single entry, we call it incomplete record. Then what is single entry system of bookkeeping? So the ledgers are here. You can see the cash ledger, sales ledger, purchase ledger, nominal ledger. Then you can also look at the disadvantages of incomplete record and the meaning of accounting, a single entry accounting system. So this will serve as the basic introduction of accounting in this particular online tutorial, and we encourage you to watch out for our next video on accounting that will follow, that will focus more on purpose and function of source document, book of original entry, accounting equation, the ledger and the classification, the cash book, the type and the treatment of error, and use of suspense account. We shall give you this and more of question and solution from the previous past question. We would like you to subscribe to our YouTube channel and to like and share our video with your colleagues. Thank you for your time.